Okay, so you want to own a parking garage. It sounds like the easiest business in America. No inventory to spoil, no customers to please, no product to design. Just a slab of concrete, a painted line, and a gate arm that goes up and down. Someone drives in. Someone pays. Someone drives out. Repeat, forever, for the cost of doing almost nothing. Here's the number that breaks that picture. In 2006, the city of Chicago leased its 4 biggest downtown garages. A 99-year deal, 9,176 spaces, the largest underground parking system in the country, for $563 million. The buyer was a venture backed by Morgan Stanley. By 2014, that venture had defaulted on its debt and handed the garages to its lenders. In 2016, the lenders sold the lease for $370 million, an 8% loss on what they'd put in. Same garages, same cars, same painted lines on the same concrete. Nobody stopped parking there in 2014. The stadium crowd still came. The commuters still pulled in every weekday morning at 8. And yet one owner lost money on the exact asset another owner is still collecting on today. So no, parking isn't a bad business. It might be one of the best real estate businesses in the country, quietly generating more than $100 billion a year across tens of thousands of properties nobody thinks twice about. But almost nobody who thinks they understand this business actually owns the part of it that makes the money. Most of the people standing at the gate collecting your ticket don't own the ground under their own feet. And as we're about to see, the difference between the winners and the wreckage in this industry has almost nothing to do with how many cars show up. It has to do with a single number most people never ask about before they buy in. How much debt is sitting on top of the asset, and how patient the person holding that debt is willing to be. Start with the fantasy. You buy a lot. You pour concrete, maybe stack a few levels. You install a gate, a pay machine, a camera. Cars show up because cars always need somewhere to sit for 8 hours while their owner is at work. You collect. That's the pitch. Here's the first crack in it. Most of the people running America's parking don't own a single space they operate. The largest parking company in North America, SP Plus, doesn't primarily buy garages. It manages them, on contract, for a fee, on behalf of whoever actually owns the concrete. Cities own garages. Universities own garages. Hospitals, airports, pension funds, private equity real estate arms, insurance companies, they own the dirt and the structure. Then they hire an operator to run the gates, collect the tickets, and hand back a check. The operator never has to worry about a defaulted mortgage because the operator was never the one who borrowed the money. That split matters more than anything else in this industry, and we'll come back to it. And it's not just the physical operators who never touch the concrete. Layer a second group on top of them, the booking platforms. Apps that let a driver reserve and prepay a spot before they even leave home take a commission on every transaction, without owning a single space, without carrying a single dollar of construction debt, without ever being on the hook if a garage sits half empty during a slow month. They sit on top of the operator, who sits on top of the owner, who sits on top of the land. 3 layers of profit stacked on one slab of concrete. And the layer closest to the concrete is usually the one carrying the most risk for the least guaranteed return. Now the scale. The United States has, by the most rigorous industry accounting available, somewhere around 1 billion striped parking spaces. Some estimates that count every driveway, alley, and half-empty church lot put the number as high as 2 billion. For roughly 250 million registered vehicles. That's not a typo. That's up to 8 parking spaces sitting empty for every single car in America, most of the time, for free. And the industry built on top of all that concrete generates real money. The National Parking Association's own economic study put the U.S. parking industry's annual revenue at roughly $131 billion, supporting $176 billion in value added, about 1% of the entire U.S. economy, and more than 500,000 direct jobs in 2018 alone. Here's the part that should stop you before you write a check for a piece of it. Only around 1 in 10 of those billion-plus spaces is actually paid parking. The other 9, roughly, sit free, a driveway, a mall lot, a church parking area empty 6 days a week, and office buildings reserved spots nobody's fighting over. You're not entering a market with 1 billion customers. You're entering a market with 1 billion parking spaces and a fraction of them ever changing hands for money. One side, a business generating well over $100 billion a year, embedded in nearly every American city block, propping up downtown real estate values from Manhattan to Millennium Park. The other side, an industry so structurally fragmented, so low on barriers to entry, so oversupplied with free alternatives sitting one block away, that almost none of the people who build it end up holding the asset that's actually worth anything. Ownership itself is scattered across cities, universities, hospital systems, airport authorities, pension fund infrastructure arms, and thousands of small private landlords who inherited a lot from a parent and never thought about it twice. You're not buying into a monopoly. You're buying into the most contested, oversupplied real estate category in the country, and betting you can be the operator, or better yet the landowner, who doesn't get squeezed when the next downturn thins out the transient customers first. Widely cited land use estimates put the share of incorporated land dedicated to parking in Los Angeles County at around 14%, an entire city's worth of surface area, sitting there, waiting for a car that isn't there most of the day. That's not a hidden niche business. That's a load-bearing piece of how American cities are physically built, hiding in plain sight, undervalued by almost everyone who drives across it every day without a second thought. Let's build one, starting with the part almost nobody accounts for first, the land. An acre of raw land in the U.S. can run anywhere from $1,500 to $200,000. And in the kind of downtown block where paid parking is actually worth building, you're at the top of that range or well beyond it, because if the land were cheap, it wouldn't need paid parking in the first place. That's the trap baked into the business from day one. Parking is only valuable exactly where land is expensive, and land being expensive is exactly what makes the parking expensive to build. Now the structure itself. A surface lot, just paint and gravel, no levels, runs somewhere between $1,500 and $10,000 per space. Cheap. Fast. That's why most operators start there. A single-level garage jumps to roughly $14,000 to $21,000 per space. A multi-level above-ground structure runs $19,000 to $35,000 per space. Industry analysts put the 2024 national median at just under $30,000 per space for a structured deck. And if you need to go underground, because there's no land left to build outward, the number climbs to $35,000 to $50,000 per space, sometimes more, once you've paid for excavation, waterproofing, and ventilation systems that a surface lot never has to think about. In New York City specifically, where land scarcity is at its most extreme, a single new structured space can run as high as $36,000, and that figure doesn't even include the cost of the land underneath it. So here's the ladder, stacked the way it actually gets paid. $1,500 a space on a gravel lot, $20,000 for a single level of concrete, $30,000 for a mid-rise structure, $50,000 if you have to dig, and that's before you've sold a single ticket. Notice what that ladder is actually measuring. It isn't measuring how much more valuable a parking space becomes as you build it taller or dig it deeper. A car parked underground isn't worth more to its driver than a car parked on gravel. It's measuring how much it costs to fit more cars onto the same expensive piece of land. Every rung on that ladder is a bet that squeezing in one more level of concrete will pencil out against the land cost you're paying regardless. Get that bet wrong. Build 5 levels where the market only ever fills 2, and you've turned a parking business into a very expensive, mostly empty concrete sculpture. Then come the layers that don't show up in the construction estimate. Fire suppression and sprinkler systems, sized for the entire structure, not just the ground floor. ADA-compliant spaces, ramps, and elevators, non-negotiable, code-mandated, and expensive to retrofit if you get the count wrong. Striping alone costs $4 to $5 a stall, which sounds trivial until you're painting hundreds of them, on a schedule, before you can legally open. Structural engineering sign-off on every level, because a parking deck is one of the few commercial structures explicitly built to carry the rolling, concentrated weight of vehicles. Get the load calculations wrong, and you're not looking at a fine, you're looking at a structure that has to come down. Insurance is its own escalating ladder. General liability, for the slip and fall and the fender bender. Garage keeper's legal liability, for the car that gets damaged or stolen while it's in your custody. Umbrella coverage, Because a multi-level structure with public vehicle access is exactly the kind of property that draws a lawsuit the moment a stairwell light burns out and nobody replaces it in time. None of these are optional line items you can skip to protect your margin. Skip them, and one incident wipes out several years of ticket revenue in a single settlement. Then property tax, assessed not on what the garage earns this year, but on what the underlying land is worth, which in a hot downtown market can rise every single reassessment cycle whether your occupancy rate goes up or down. And one more risk nobody puts in the pro forma: the assumption that cars will keep showing up at all. Ride-hailing apps have been quietly eating into exactly the kind of short-stay, event-night parking that used to carry the highest margins. A customer who used to pay $30 to park for a concert now pays a driver instead and never touches your gate. Build a structure sized for 2015 level demand, and you may be running it in a market where that demand simply isn't coming back the way it once did. And as we're about to see, that's still only the cost of building it. The cost of running it is a completely different fight. Here's where the business either works or quietly bleeds you. The naive model says, charge by the hour, multiply by spaces, multiply by hours in a day, and that's your revenue. In practice, no garage runs anywhere close to full for most of its operating hours. The real engine isn't the hourly walk-up customer, it's the mix. Monthly contract parkers are the foundation. They pay less per hour than a transient customer, but they guarantee occupancy and cash flow every single month, recession or not, rain or shine. A garage that's 60% monthly and 40% transient behaves like a much more stable business than one betting entirely on daily walk-ins. Transient, hourly parking is where the real margin lives, but only in short, high-value bursts. The commuter who parks for 9 hours pays a flat daily rate that works out to pennies an hour. The theater-goer who parks for 90 minutes downtown pays a rate that, annualized, would be absurd. Nobody would ever agree to it stated that way. They just don't think about parking that way. Then there's the layer most drivers never register consciously: event and surge pricing. A garage 2 blocks from a stadium on a normal Tuesday might clear $8 a car. On a concert night, the same spaces can clear 30, 40, sometimes more, for the same square footage, the same overhead, the same staff already on shift. And underneath all of it sits the quiet, unglamorous fee layer: reservation platform commissions, EV charging surcharges, valet upcharges, late exit penalties, lost ticket fees. None of them individually move the needle. Stacked across tens of thousands of transactions a month, they do. But here's the twist that the Chicago story is about to make painfully literal. None of that operating cash flow, not the monthly contracts, not the event surge, not the fee stack, is actually what makes a parking asset valuable. What makes it valuable is the land underneath it. A parking garage on a $100 million downtown block isn't really a parking business. It's a real estate holding company that happens to rent its air rights out by the hour while it waits for the land to appreciate, get rezoned, or get redeveloped into something denser. The operating income pays the bills. The land value is where the actual return lies, and land value doesn't show up in a monthly parking report. It shows up on a balance sheet 20 years later when someone finally sells. Which means the person who profits most from a parking garage is very rarely the person running it day to day. It's whoever owns the dirt. This is exactly why so much of the parking industry runs on ground leases instead of outright sale. A landowner, a family estate, a diocese, a university endowment doesn't sell the block. They lease the ground under it to an operator for 20, 50, sometimes 99 years, collecting a fixed or escalating rent while someone else pours the concrete, hires the attendants, and absorbs the day-to-day operating risk. Airports run their terminal parking almost exactly this way. The airport authority owns the land and the structure outright, then hands a management contract to an operator who's paid a fee plus a small share of revenue. Never equity, never the property itself. The airport keeps every dollar of appreciation. The operator keeps a predictable paycheck. Neither one is exposed to the other's downside. That single design choice, rent the ground, don't sell it, is the quiet decision that separates the owners who compound wealth over decades from the owners who get wiped out the first time revenue dips for 2 years running. And staffing sits underneath all of it, as the one operating cost that scales the slowest with technology. Even a heavily automated garage, license plate recognition at the gate, app-based payment, no ticket booth, still needs cleaning crews, security patrols, elevator maintenance contracts, and someone answering the phone when a customer's car won't start at 11 at night. Labor doesn't show up as dramatically as a $50,000 a space construction bill, but spread across 3 shifts, 7 days a week, across a garage with thousands of monthly transactions. It's the cost that quietly determines whether the cheap-to-run pitch from step 1 was ever true. So let's go back to that deal from the cold open, because the timeline is where this whole industry's logic either holds up or falls apart. December 2006. The city of Chicago, under Mayor Richard M. Daley, closes a 99-year lease on 4 downtown garages, the underground systems beneath Millennium Park, Grant Park, and Maggie Daley Park. 9,176 spaces, the largest underground parking system in the United States. The buyer, a venture assembled by Morgan Stanley, operating as Chicago Loop Parking LLC. Price, $563 million upfront. To fund it, the venture borrows $403 million on top of its own equity, a heavily leveraged bet that nearly a century of parking cash flow would comfortably cover the debt service. For a moment, it looks fine. 2007, the first full year under the new owners, the garages bring in about $35.3 million in revenue. Then comes 2008. The financial crisis hits downtown office occupancy, tourism, and event traffic all at once. Right as this leveraged buyer needed steady cash flow to service $403 million in debt. Revenue doesn't collapse overnight. It just quietly erodes, year after year. By the 7-year mark, adjusted for inflation, garage revenue had fallen by roughly 26% from where it started. Annual income had slipped from that $35.3 million to under $29.7 million. That gap, declining income, fixed debt payments, is the exact mechanism that kills leveraged real estate deals. Not one dramatic event. A slow-motion mismatch between what the asset earns and what the buyer owes on it, widening quietly for years before anyone outside the boardroom notices. Notice who wasn't exposed to any of that mismatch. LAZ Parking, based in Hartford, Connecticut, won the contract to actually run the garages back in 2006. The gates, the attendants, the day-to-day operations. LAZ didn't borrow the $403 million. LAZ didn't sign the 99-year lease with the city. LAZ collected an operating fee for doing the job it was hired to do, while, several floors up in a different building entirely, Morgan Stanley's financing structure was quietly coming apart. January 2014. Chicago Loop Parking defaults. Morgan Stanley's venture hands the garages over to its lenders, a deed in lieu of foreclosure, the real estate equivalent of tossing the keys on the table rather than fighting the bank. The lenders, a consortium including major European banks, now own a 99-year lease on America's largest underground parking system, and none of them are in the parking business. 2016, the lenders sell the lease. Buyers, Northleaf Capital Partners out of Toronto and AMP Capital out of Sydney. Pension fund-style infrastructure investors, patient capital, no leverage anywhere near what sank the last owner. Price, $370 million. Run the numbers on that one, because they deserve to stand alone. $403 million borrowed in 2006. $370 million recovered in 2016, an 8% loss on principal, before even counting a decade of lost interest and opportunity cost. On an asset that never stopped generating revenue, never stood empty, and never lost a single parking space to a wrecking ball. The concrete performed. The financing didn't. And 2 blocks away, the almost identical sequel. In 2008, the same city, the same mayor, the same Morgan Stanley network of investors leased Chicago's 36,000 parking meters for 75 years, $1.15 billion upfront, approved by the city council in barely 72 hours. The city's own inspector general later concluded Chicago had been paid roughly $974 million less than the deal was actually worth. By some counts, the investor group had recouped its entire $1.15 billion outlay within about a decade, leaving 5.5 more decades of pure profit on the table for them. Same city, Same investor network. Same underlying asset class. Pavement, painted lines, a payment machine. One deal, over-leveraged against a single crumbling property, collapsed into a lender takeover and an 8% loss. The other deal, structured as a simple long-duration lease with no debt spiral on the buyer's side, is now widely cited as one of the most lucrative infrastructure trades in modern American history. Look at the two deals side by side, and the contrast becomes almost a controlled experiment. 26 years of pavement, painted lines, and a payment machine structured two different ways by the same buyer network, for blocks apart in the same city. Not because the second deal collected more revenue per square foot than the first. Nobody has ever seriously argued that meters outperform a 9,176 space underground system on a per-space basis. The difference is that the meter deal never carried $403 million of acquisition debt sitting directly on top of it, waiting for a bad year to break the payment schedule. It was structured to survive a downturn. The garage deal wasn't. The parking didn't change. The financing did. So who actually won across every version of this story? Not Morgan Stanley's Chicago Loop parking venture. It borrowed against volatile operating income and got wiped out when that income dipped. Look at who never stopped getting paid through the entire collapse. The operator. SP Plus, the same company that ran these garages for the city before the 2006 privatization, came back afterward under new ownership, managing the very same 9,176 spaces on a fee-based contract. Morgan Stanley's equity was erased. The lenders took an 8% hit. The operator collected its management fee the entire time, through the default, through the foreclosure, through the resale, because the operator never owned the debt. It only ever owned the contract to run the gates. That's the split from step 2, made real. Whoever holds the leveraged asset absorbs the risk when cash flow wobbles. Whoever holds the light, fee-based contract keeps getting paid regardless of who's technically holding the deed that week. And zoom out one more level, to the city itself. Chicago never had to operate a single parking space to collect 30 years, really, closer to a century, of proceeds up front. It sold the right to future volatility to someone else, in exchange for guaranteed cash today. Whether that was a good trade for Chicago's taxpayers is a separate, much angrier conversation. But structurally, the city did exactly what the winning move in this industry always looks like. It kept none of the operating risk, and it got paid regardless. Not because Morgan Stanley's team was incompetent. Not because the garages were badly built. Because the capital structure, how much debt sat on top of how uncertain a revenue stream, decided the outcome before a single car ever pulled up to the gate. While the leveraged owner was betting on parking revenue holding steady for decades to cover its debt, the operator and the landowner had already built themselves out of that exposure entirely. And the newest layer on top of all of them, the booking apps taking a commission on every reservation, never had to think about any of this at all. They don't own concrete. They don't own debt. They own a piece of software that gets paid the moment someone taps reserve, whether the garage underneath it is owned by a Wall Street bank, a Canadian pension fund, or the city itself. Look at who bought the garages the second time, in 2016, and the pattern gets even clearer. Not another leveraged Wall Street bank chasing a quick return. Northleaf Capital Partners and AMP Capital, the kind of infrastructure investors who manage money on behalf of pension funds, built specifically to hold an asset for decades and collect a steady, modest yield rather than flip it for a leveraged gain in 5 years. Patient capital bought the same garages that impatient, over-leveraged capital had just lost. That's not a coincidence. That's the entire industry's risk finally getting matched to the kind of buyer who was actually built to hold it. The pattern repeats at every scale in this industry, from a single family-owned lot behind a diner to a 9,176 space system beneath one of America's most famous parks. The closer you sit to the concrete and the debt, the more exposed you are to a bad year. The further you sit from it, the operator collecting a fee, the landowner collecting rent, the platform collecting a commission, the more likely you are to still be getting paid a decade from now, regardless of who's currently listed on the deed. Back to that single painted white line on bare concrete, the one we opened on. It doesn't know who owns it. It doesn't know if the entity collecting the ticket money this month is a city government, a Wall Street bank, a Canadian pension fund, or a publicly traded operator with no equity in the ground beneath it at all. It just sits there, doing the one job it was painted to do, decade after decade, regardless of whose balance sheet it's currently sitting on. That's the real lesson underneath the concrete. The parking business rewards patience and punishes leverage, and almost everyone who enters it enters believing the opposite. They picture the gate arm and the cash box. They rarely picture the loan officer, the debt schedule, or the decade it takes for a downturn to finish quietly eroding a revenue line nobody was watching closely enough. Every operator who has ever run these garages, standard parking before 2006, LAZ from 2006 to 2016, SP Plus after, kept doing the exact same job through every single ownership change. Open the gate, print the ticket, close the gate, deposit the cash. The concrete never noticed who owned it. Neither did the cars. So if you're still picturing yourself pouring that first slab, are you building a parking business, or are you building a real estate bet wearing a parking business as a disguise? And when the debt comes due and the revenue dips, even a little, even for a year or two, will you be the operator still collecting your fee, or will you be the name on the loan documents when the lenders come to take the keys?